This is InvestTalk. Independent thinking, shared success. Justin Klein and Steve Peasley stand ready to take your finance and investment questions and share their unbiased answers. InvestTalk is made possible by KPP Financial, a registered investment advisor firm serving clients throughout the United States. The clarity for your path forward starts now. Here is KPP Chief Executive Officer, Financial Advisor, Justin Klein.
Good afternoon, fellow investors, and welcome back to InvestTalk. This is our August 30th, 2022 edition of InvestTalk. Yep, only one more trading day in the month of August, and then we head into the final month of the summer, a few weeks of the summer, and an eventful time in the market as well. And I'm here to help guide you through these trying times and help you get prepared for the more fruitful times. And of course, I'm Justin Klein, and I appreciate you all tuning in for this hour. I have a lot to unpack for you today. And the main one is that our main focus point is that about the Great Resignation, how it's fading and employees are toning down demands for higher pay and remote work accommodations. So it's a big thing that we're going to cover today, as well as your questions. Your questions are always top of mind. So I encourage you to reach out with any questions 24 hours a day, 7 days a week. The number is always 888-99-CHART. So I'm going to get to that main focus point, but I have some others as well. I didn't get to the U.S. and China audit deal that came down just last week, and what that might mean for those stocks that are listed here on the U.S. exchanges. Also, I want to touch on nuclear, and there's a few more signs that politicians around the world, not just here in the U.S., are starting to become a little bit more realistic when it comes to how to address the energy crisis that we're currently in. And then I want to get to some other topics. One is about globalization and how some companies are fighting back, but I want to go over the pros and cons of the reversal in globalization. And then lastly, we're going to touch on the energy situation in Russia and how, frankly, the sanctions haven't really hit them too bad. So those are the things that are on the docket for me today. But ultimately, I want to know what's on your mind. So give me a call at 888-99-CHART. And we're going to take our first listener question now.
Hello, my name is Dominic, and I'm wondering what your thoughts are on Tyson Foods, and the symbols are TSN. Thank you very much. Bye-bye.
All right, looking at TSN, Tyson Foods, obviously a consumer staple when you're talking about one of the largest producers of beef, chicken, pork, and related products. 2.4% dividend yield, but earnings are expected to be an all-time high of $8.88 this year, but down 14% to $7.64 next year. And that's the main issue I have with it is it's been kind of over-earning, and they're not going to be immune to the spiraling costs as well. So yeah, it is the largest producer of processed chicken and beef, as well as a huge producer of pork. And they own Jimmy Dean, Hillshire Farms, Ballpark, Sara Lee, State Fair, as well as Raised and Rooted. 81% of its products are sold here in the U.S., 47% through retailers, 32% through food service providers, and about 10% through the packaged food industry. About 11% comes from overseas. So that's one positive, that it's, especially in a strong dollar economy, that there's not that huge exposure to foreign markets, but it also means it's more levered to our current market. And as people's belts are tightening, they're just going to naturally spend less on protein and meats. Now, this is in a clear downtrend. It's off about 24% from its 52-week high. And I'm going to pass on this. I just don't like the technicals. They're pretty bad. And I don't like that reversion to the mean. Analysts are downgrading their earnings for this year and next year. And I don't like that reversion trend. So I'm going to pass on Tyson Foods. Good name to have on your watch list. If it gets down into the low 60s, then I might think about it. But at 76, I'm holding off. Let's go to Axel in Chino, looking at 3M.
Yeah, thank you, Justin, for my question. I'm wondering on 3M. I know there's going to be a spin-off with another company, and on a similar process, I've had AT&T for about a decade, and I know it had that spin-off, and we got Warner Brothers, and I kind of don't understand how when you have a spin-off like that, I want to feel like Warner Brothers completely down like 80%. And I don't know if that's going to happen in 3M, so I was wondering, should I just get rid of my position right now while I might be down about 10%?
Yeah, so it's a great question. There's a couple things to hit on here, and one are spinoffs. Now, historically, spinoffs are value accretive in the long term, meaning you break up a company that's so large like 3M and you spin off a smaller portion that's more of a pure play, where it's focused, I think in this case, it's healthcare. They're kind of spinning off their healthcare assets and merging with another company. And then that's suddenly going to become, a pure play healthcare entity. Whereas currently it's underneath this umbrella of this large industrial conglomerate. And therefore investors can go and focus on their investment on the healthcare side. Now, long term, that typically is good. But in the near term, and you're seeing that with Warner Brothers, that's actually technically bad because most people own 3M. Think of an industrial ETF, and they're getting the spinoff. Well, it doesn't fit industrials. They don't want industrials. They want industrials. They don't want a healthcare spinoff. So they're likely to sell that spinoff in the near term, and that actually puts pressure on the stock on that spinoff in the shorter term. Now, long term, though, once again, I think it's value accretive. It's better. But near term, as you're seeing with Warner Brothers, there is a lot of pressure because people don't want to hold something that they didn't feel like they were getting with the previous entity. And so short term, probably negative. And then you also have on top of that with 3M, the other thing to hit on is not just the spinoff, but this lawsuit that is basically was a subsidiary that went bankrupt, and they thought they were immune from liability, but a judge was ruling they're not, and that's why it's also gotten hit. So just a lot of things are hitting 3M all at the same time, and frankly, it's just not something I would own in the short term. Now, long term, once they clear out this litigation, this overhang, it's probably be a good buy, but in the near term, I think it's going to continue to go lower because the chart is very, very weak. So I'm going to say I would not be a holder of 3M at the moment. Thanks for the call. Now we're heading into a break, and I welcome your finance and investment questions now. No question is too simple or too complex. You set the agenda, so give us a call at 888-99-CHART.
Why do listener questions make InvestTalk better?
Which of these would you recommend?
Because each caller presents fresh questions in their voice.
I was curious if you still think aluminum has a ways to go from here.
When do I know the right time to take profits?
Should I be looking for an exit? Should I be holding here?
And listeners instinctively realize that InvestTalk uniquely offers a welcome dose of investing satisfaction.
I think you have a terrific show, and I've learned a whole lot.
Hey guys, love your show. I've been listening for several years now, and I've learned a lot.
Justin Klein and Steve Peasley understand what investors need and want.
I would look at it from a tax perspective. If there's no tax implications, move on, find better ways to use that money.
I'm going with the odds. I think a half position now would at least get you in it and get you watching it so you won't lose track of it.
Don't forget to call InvestTalk, 888-99-CHART.
One of the most rewarding things I do each weekday is host the InvestTalk podcast. I truly enjoy helping investors, and I know that every question counts and every answer I provide will be unbiased. You, the caller, get to chart the course for each InvestTalk podcast. Call with your questions anytime, day or night, 888-99-CHART.
Let's go over to North Carolina and talk with Sid, looking at BSCQ. B as in boy, S as in Sam, C as in Charles, and
C
Q.
as in Charlie. Yeah.
There we go.
Q
Yeah.
as in Queen.
Okay, and this is the Invesco Bullet Shares 2026 Corporate Bond Fund, correct?
Yes, that's correct. And I have never done any. First of all, thanks for taking my call. It's been always a wonderful talking to you and great session. So I have never taken any ETF, but few of my friends were discussing and they were looking for investing, and I definitely could not figure out what is your take on this one. Is it something we should look for a good long term? Thank you for your answers.
Well, what's your definition of long term? This is the bullet shares. So these are all bonds that mature in 2026. So that's what the bullet shares do. So instead of having this constant changing maturity date of a bond fund, this has only bonds that mature in 2026. And therefore, once 2026 comes around, or the end of 2026 comes around, this will return to par. Everything, there might be some bankruptcies in the portfolio between now and then, but assuming the vast majority of them reach their maturity date and go back to par, then you're going to get the par value back, and they're going to return the money to you, the holder of the ETF. So this is 2026. That's 4 years from now. So call it 3.5. So is this something that you would consider long-term? Kind of, sort of. But that's what you really are looking for here. Yield's about 4%, which is okay. You're getting a mix of mainly investment grade. Triple B is 51% of the portfolio. A is 37% of the portfolio. Double A about 7.5% of the portfolio. Triple A only about 1.6 because there's not a lot of triple A issuers out there. So you're getting mainly investment grade at 4%, which is good. It's relatively low duration, 3.8% modified duration, which is what you expect for something that's only going out about 4 years. So if this is what your target is, you don't want a lot of duration risk, you want all your money back sometime in 2026, this is the name for you. But I wouldn't call it a long-term investment. I would call it more medium-term. Thanks for the call. 888-99-CHART, 888-992-4278 is how you get through and ask your question today. Let's take a look at the market with the S&P down about 44 points, a little over 1%. And this is the first real follow-through day from last Friday's sell-off after the Jackson Hole speech that really kind of spooked the markets. And we're back to expecting a 0.75% hike on the Fed funds rate in the Fed meeting in September in just a few weeks. Now, one kind of positive late in the day was a note from the White House that they're expecting a weak jobs report, or to warn the public to expect a weak jobs report. And so that gave the market a little bit of lift, saying that, hey, maybe that's a hint that they know something that the market does not, which is that jobs number that's this Friday is going to come in pretty weak. And then that's one more shot across the bow to push the Fed to maybe not hike as aggressively. So that gave the market a little bit of life late in the day. And what was interesting is the dollar was actually down slightly today, even though you had rates. What do rates do? Yeah, rates were flat, so that's kind of expected. But the equity markets are acting more spooked on the Fed rate hike than the bond or the currency markets are. And that's something that's kind of a tell for me that equity volatility can often be driven by volatility matching funds and different types of algo-driven funds. I mean, they have an algorithm that if volatility goes up, they do X, Y, and Z. If the performance for the month is for stocks is higher than bonds, and they reallocate from stocks to bonds, etc. And there's a lot of those kind of gyrations that are happening here near month end. And so I think that was a lot of the volatility today, because there really wasn't a whole lot of volatility in the bond market. And so it was really driven mainly by those algos. So we'll see how we close the month, but we do get, once again, jobs ADP figures tomorrow. So that'll be a hint at what that Friday number will look like. And I believe we also get the ISM prices paid index. That's going to be a big data point tomorrow, which will be, that's on the manufacturing side. It's not as important as the services side, but still interesting, and will be a big data point to watch tomorrow as a hint towards what CPI will be for the month of August. Now, this is InvestTalk. I'm Justin Klein. We have one goal here on this program to help you achieve your own version of financial freedom. And our work continues after this break. So give me a call now at 888-99-SHARP.
Each day, InvestTalk listeners submit their finance and investment questions via phone or email. Would you like your question to be put near the top of the list? Just take a minute or two to leave a review and rating for InvestTalk at iTunes. And be sure to include a brief question with your iTunes review comments.
Now, my focus point today concerns this headline. Employees are toning down demands for higher pay and remote work accommodations. And this was a study done by Harris Poll for Bloomberg. And more than half of employees believe their bosses have the higher ground in the workplace. And that's a 5% jump from January. And what this means is that workers feel less empowered to ask for perks and raises, as well as the ability to work remote. And that's a bit of a shift over the past couple of years. Now, nearly 3 in 5 respondents, 59%, so they don't feel comfortable asking for a raise. And only about half of respondents think that they have a shot at negotiating a flexible work arrangement, which is down huge. And you're already seeing this announced today. Goldman Sachs said that they want all employees to come back to work. And then even companies like Compass, Coinbase, Uber, Twitter, Wayfair, Daily Harvest, Groupon, Ford Motors, they're all attempting to either bring workers back to the workforce, or they're just simply laying off workers. Now, those who started to join the Great Resignation are a bit fearful right now, because there's that typical last in, first out rule. When business gets tough, you tend to get rid of those that have the least seniority over those that have been there a long, long time and have entrenched themselves into the workplace, into customers and clientele lives, etc. And that's really the big issue for those that have just recently changed jobs. Now, according to Insight Global, which is a staffing firm, nearly 80% of workers are concerned about their job safety, and 87% of managers said they would likely need to lay off employees if a recession hits. So companies are not afraid to lay off workers. Now, 60% of people in the Harris poll said they believe they could still readily find a higher paying job, and half said that they're already trying to nab some offers from other companies to leverage raises with their current boss. So while the trend in the labor market is certainly weakening, it's still relatively strong because of low labor force participation, a lot of baby boomers retiring, and just simply not enough people until millennials have kids. When millennials have kids and they grow up to be working age, then we'll suddenly have enough workers. But that's probably not for a decade or probably 2. Now, more than 3/4 of business leaders polled in a Jones Lang LaSalle survey said they are offering remote or hybrid work is critical to talent attraction and retention. And so the hybrid model is now pretty much a permanent fixture of the workplace. So even if you did lose your job or move jobs, the odds are good that your next job is likely to be remote or at least hybrid. So that's, I guess, one positive of a weakening labor market. The efficiencies of hybrid work, remote work are likely to stay in place if you're a white collar worker and you are just moving jobs or eventually find another one. So interesting study there. Once again, a weakening labor market, but certainly not a bad one. Now let's swing back to the InvestTalk voice bank for a question that came in earlier on an anytime listener line at 888-99-CHART.
Hey, Steve and Justin. First of all, I just want to thank you for the podcast. 2-year listener and try to listen every day. My question for you is about ICLN, ICLN. It's a clean energy ETF. I was listening to the Wednesday 24th podcast, and you guys are talking a lot about energy. With the recent downturn, I think it might be a good entry point there. Or if there's other ETFs out there, I know you can't say specific ones, but if there's a better one out there, please let me know. I own a little bit in it right now. I'm trying to basically double my position. Thanks for the podcast.
All right, looking at ICLN, which is the iShares Global Clean Energy ETF. And I think you definitely need to separate clean energy from traditional energy, traditional oil and gas and coal, because those are very different. Clean energy requires a lot more inputs, just a complex supply chain, and there can be companies that benefit from the move towards green energy, but are going to be more of the companies that make the solid products. Think of those that make the solar panels as opposed to those that install the solar panels. And not necessarily solar panels in general. I don't like solar panels as a good proxy here, although there is a lot of tax incentives. But in the new Inflation Reduction Act, the issue is that the vast majority of this industry is overhyped, overpriced, and their business model is very weak, meaning they don't tend to make good profits even in a time where everyone's trying to move towards clean energy. So think of those as very different. One is more speculative, one is more real world. If you want to invest in energy, today's world, you want to focus on those traditional energy sources because those clean energy sources, while they're growing, vast majority of those companies have not shown the ability to sustain profitability and have good cash flow over the longer term. So focus on traditional energy. Thanks for the call. Now tomorrow we're going to talk about China's debt bomb and is it ready to explode? We're going to dig into that story tomorrow. But for now, I'm Justin Klein. I'm ready to take your questions live at 888-99-CHART. Take a guess. How many job seekers do you think visit LinkedIn every week? The answer is 40 million. As anyone who has ever had to search for excellent job candidates can tell you, finding the right job seeker can be a daunting task. That's why you will appreciate the power of LinkedIn. Create a free job post in minutes on LinkedIn Jobs to reach your network and beyond, to the world's largest professional network of over 810 million people. Then, add your job and the purple #hiring frame to your LinkedIn profile to spread the word that you're hiring so your network can help you find the right people to hire. Simple tools like screening questions make it easy to focus on candidates with just the right skills and experience so you can quickly prioritize who you'd like to interview and hire. It's why small businesses rate LinkedIn Jobs #1 in delivering quality hires versus leading competitors. LinkedIn Jobs helps you find the candidates you want to talk to faster. Did you know every week nearly 40 million job seekers visit LinkedIn? Post your job for free at linkedin.com/invest. That's linkedin.com/invest to post your job for free. Terms and conditions apply.
When you look into Discover Student Loans, what you see might surprise you. We can help cover your college costs, don't charge you fees, and give you cash rewards for good grades. Ready to apply? Visit discoverstudentloans.com. Limitations apply.
Have you heard about Riskalyze? It's a brief question and answer form that you fill out online. Steve Peasley and Justin Klein will also get a copy of your responses. They can use the Riskalyze results to help you formulate a strategy that fits your investing risk tolerance. Learn more anytime and take the Riskalyze quiz at InvestTalk.com.
Hey, I'm interested to buy this stock for a dividend play, SBLK. Is SBLK a good dividend stock to buy for a long-term investment? Thank you so much. Keep up the good work. Bye.
All right, looking at Star Bulk Carriers, and this is a international tanker transportation service company in the dry bulk business. 128 dry bulk carriers that it owns, and earnings skyrocketed post-pandemic. They only made 17 cents in 2020, but $6.82 last year. So it's supposed to make $7.17 this year and $5.14 next year, down 28%. Now you're probably looking at that juicy 34% dividend yield. And anytime you're looking at that, you should always, if you ever see that, you have to shake your head and be like, that's not sustainable, and it's not realistic. And that's kind of what you're seeing here. And if you just go back to the early 2000s, it was paying 8, 9, 10, 14, 15, 17% all through the early 2010s. And then what did they do? They eliminated their dividend back in 2013. So this is certainly an extreme example. And most of these dry bulk carriers are like this, where they promise a big dividend, but underneath the surface, their business is pretty bad, because at the end of the day, nobody cares who's carrying their raw materials, their commodities. And so the profit margins in these businesses are very, very small, and oftentimes negative, and they've been consistently negative for the space. Now, people chased this back in 2009 from the low of about $100 per share. It kind of chopped sideways until 2014, and when it was at about $18 per share, let's call it in the mid-20s, and they cut their dividend. So while it paid a healthy 8, 9, 10, 12% dividend from 2009 to 2014, it was doing so on the back of pretty bad earnings and leveraging up the balance sheet, and eventually they just had to cut the dividend outright, and they didn't pay it until recently. So look at the history. Once again, when you invest in a company for a dividend is always secondary. This is, I've been harping on people that are focusing too much on exciting names, growth stocks, the Lucids of the world, the Zooms of the world, the companies that are now down 80, 90%. I've been warning about them for the last 2 years. And now what's interesting is now that those are out of favor, everyone's just chasing dividends, and they're not understanding the underlying quality of the business. Where is that dividend coming from? There's a lot of companies out there that are paying high dividends because they have over-leveraged balance sheets, and they're trying to, maintain that and keep their business in business, and they're trying to attract investment dollars. And so that's all well and good in the near term, but longer term, unless they can have a sustainable, profitable, cash flowing business that can pay 100% or more of that dividend, it's going to get cut eventually. And Star Bulk Carriers is a good example of that. So is this a sustainable dividend? Absolutely not. Focus on quality businesses. Dividend is always secondary. Thanks for the call. 888-99-CHART, 888-992-4278 is how you get through and ask your question on today's show. Now, let's touch on a new agreement between Washington and Beijing, and this is somewhat of a landmark agreement that will allow U.S. regulators access to audits of Chinese companies that are listed on U.S. exchanges. Now, this would halt the threatened delisting of about 200 different names that are listed on Wall Street of Chinese names. And Beijing historically has not allowed foreign regulators to inspect Chinese companies' audits. And they mainly have cited protecting state secrets. But with this threat looming, they've suddenly given in to the demands of the Public Company Accounting Oversight Board here, which is a U.S. auditor watchdog, And so as they said on Friday that it would allow them the power to select companies, audit engagements, and potential violations it inspects and investigates without consulting Chinese authorities. So having independent oversight, really, of the audit process and the audit companies. Now, under this deal, the Chinese companies are going to be in Hong Kong, the PBAOC, the Public Company Accounting Oversight Board, is going to be in Hong Kong in mid-September to begin their inspections. So that's really where the rubber will meet the road. And SEC Commissioner Gary Gensler has not spoken softly about this. He says, quote, "Make no mistake, though, the proof will be in the pudding. This agreement will be meaningful only if the PCAOB actually can inspect and investigate completely audited firms in China," end quote. So that's really the gist of it here is, yes, this is an agreement in principle, but they have not actually gone there. What's going to happen when they dig into these reports, into these audit reports, and they start to ask questions and they follow up on those answers and they really do true regulatory work? Will the Chinese government actually give in to the demands of the PCAOB? And this involves the big four accounting firms that work in mainland China as well as Hong Kong. And several people close to the matter said that the pilot would have to go very smoothly in order for them to accept that China was compliant with the U.S. audit disclosure rules. So this is one of those things where you can't take the headline as is. You really have to say, is China really, after all these years, are they going to comply with our regulatory demands? Things that scrutinize their businesses? I have a hard time believing that. Let me tell you a quick story here. And so I have a good friend, one of my best friends. He is the founder and president of a company that makes devices. A lot of their devices are produced in China, or at least put together in China. The components come from a lot of different other countries. But basically, there's been a lot of knockoffs of their best-selling product in China, just dozens and dozens all over Amazon, etc., that has stolen a lot of market share from them. Well, they spent a lot of money on, actually more than Apple did last year, on suing different Chinese manufacturers for patent infringement. Well, what they did was, this company works with they have a lot of high-profile athletes that use their products, and they in court, the other Chinese company said that these athletes were shown using this product before it was officially launched, and therefore they weren't in violation of patent infringement. And that, according to Chinese judges, held water. And so it just goes to show you that no matter how much you innovate, no matter how much they steal the intellectual property in China, and no matter how much U.S. companies try to go after those companies that steal intellectual property, they're going to be on the side of the Chinese manufacturer, Chinese citizens, over U.S. companies, U.S. citizens. And so I don't see this as any different. You have a U.S. entity digging into what's happening in China. They're not going to like that. And the odds are very good that they're going to not pass the tests that the SEC is going to put on them. But we'll see. Now let's answer an iTunes review question. Will from Chattanooga says, I learn something new with almost every episode. I am curious to know your thoughts on LSB Industries, LXU is the symbol. Let me pull that up here. LXU. They're in the chemical, ammonia, fertilizer space, natural gas prices climbing in Europe. I can see strong tailwinds for this company and industry. Let's see. So they're a bit more diversified than your larger ag companies that are out there, your Mosaics and CF Industries, etc. But let me take a look here. LXU. Market cap of about 1.3 billion, so definitely in the small cap space. Its business has clearly done well, but they were losing money before this situation. Now they're repurchasing some shares, which is nice, about $100 million, roughly 8 or 9% of the portfolio of the market cap, which is good. But that was announced. Yeah, that was announced a couple weeks ago. My worry, though, is long term. Historically, they've had very, very bad profitability. They were losing money consistently pre-pandemic, and if you look at their free cash flow outside of the most recent history, it's kind of fluctuated to being negative. And in 2016, it was negative in a big, big way. So yes, they have had some tailwinds, but it looks like their business is more diversified and not something that I would want to pure play. If you're talking about fertilizer industry and natural gas prices climbing in Europe, I agree with that. But excuse me with that. I definitely think that this is not a pure play, and I would pass on it just because of the history of that negative free cash flow and poor business. Now let's keep things moving. Here comes another question, this time from a caller in Michigan.
Afternoon, guys. This is Mark from Michigan. I really like the show. You guys give good common sense information that's easy to understand. I appreciate that. I've got a question for you on a stock, MPW. It's a medical property trust. It's a REIT. I know the metrics are a little different to value a REIT. I'd like you to go over that for me if you could. Tell me what you think about it. I know the chart's so ugly its mother would probably slap it, but other than that, pays a good dividend and seems like the medical arena is a good place to be. Again, thank you, and thanks for the great show.
All right, looking at medical properties trust, and this is once again chasing that 8% yield, and the relative strength is horrendous. You're talking about 18, so 82% of positions have outperformed it over the past year, and its business is now in decline, or funds from operation are supposed to decline 20% this year. And this is a company that is mainly focused, it is medical properties, but it's mainly focused, let's take a look here. So US, Germany, and the UK, so it's a bit diversified there. Let's see here, what is it? It says healthcare facilities. I would like to know what type, but ultimately the proof is in the pudding. Their business is struggling, and this is a clear chase for yield, especially with the downtrend in the price. And I would absolutely pass on this. So this is important. I have to hit on this once again. Once again, I need everyone to internalize this, because this is when I talk about the tools. Talk at the top of the show. We're trying to give you the tools to be successful. Okay, I really want this to hit home. Dividends are only important in the sense that they give management discipline. Okay. And when the data about their business continues to underwhelm, it means that management isn't having discipline anyway. Okay. That's the long-term positive aspect of a dividend, is management is very slow to make big investment decisions because they want to make sure that they can pay that dividend. And they want to make sure that anything they're going to invest in is going to pay off longer term, above their cost of capital, above their cost of debt, especially. And so if you're just chasing the dividend and you're not focusing on other aspects of a quality business, then all you're doing is chasing after bad management. And the market is going to price it so. When you have an 8% yield, when most other REITs are trading at yields half that, that means you either have bad assets or you have bad management, or both. So first thing you should do is say, okay, let me go to maybe an ETF of that industry. What is the average company paying within that industry? Maybe even the average dividend payer within that industry. You could use that. And if it's trading dramatically above that level, the market's probably telling you something. And so when you chase high dividends, you have a strong probability that you're buying into a value trap. Now, it's not guaranteed, but it's a strong probability. And you need to investigate that. You need to convince yourself that this is not a value trap. Ignore the dividend. Focus on, is this a value trap or is it not? Now we're heading into a break. This is your last chance to give us a call for this hour with your finance and investment questions on InvestTalk at 888-99-CHART.
Have you heard about Riskalyze? It's a brief question and answer form that you fill out online. Steve Peasley and Justin Klein will also get a copy of your responses. They can use the Riskalyze results to help you formulate a strategy that fits your investing risk tolerance. Learn more anytime and take the Riskalyze quiz at investtalk.com.
Hi, Steve and Jason. My name is Mark. I am from Silicon Valley. I want to ask you the question, what do you think about the company Two Harbor Investment Corporation? It's T as a Tom, W as a window, O as orange, TWO. I own the company and it used to be in 2021 around $14. Now it's dropped about $5. What do you think? Should I continue to hold shares or to sell them? I appreciate your answer and I follow your podcast already many years and it's really good and helpful podcast. Thank you. Thank you for your service. Bye.
All right, this is Two Harbors Investments, and this is another high-yielding REIT. Now, it's different than the last one, which was focused on medical properties. This is a mortgage REIT, and it was trading at about $15 pre-pandemic, and now it's at about $5. And during times when the yield curve is rising or expanding, the yield spread, between short and long-term rates is increasing, then these typically do fairly well. And you can see this hit at a bottom during the pandemic of $2 and change, and hit a high just late last year around $8. So it's down about 28% from its 52-week high, and it's in a clear downtrend. And that's because the yield curve has been flattening and has been negative. Remember, these are investing in mortgages and they're borrowing short and lending long. They're kind of like a bank, a levered bank. And when the short-term cost of borrowing goes up, their cost of capital goes up and the amount they're receiving from those mortgage-backed securities that they've bought stays relatively static. And so that's not a great recipe for their business. And funds from operation, you can see 2017, funds from operation were $2.08. Now, 80 cents, down 2% from last year, expected to be down another 5% next year to 76 cents. And they continue to issue shares in order to pay that dividend. So the dividend is clearly not sustainable. If you look at its number of shares outstanding, which I'll pull up right here, right now it's about 344 million. That's up from 2018 when it was 175 million, and 2021, 273 million. So they continue to issue more shares when they need to delever their balance sheet. And so this is another example of chasing yield, and then especially not understanding the business, not understanding the environment that we're in, which is the yield curve expanding or is it Is it tightening and going negative? And in a negative yield spread environment, this is the exact opposite of the name you want to be in. So you want to pass on TWO or any of the mortgage REITs right now. That is Two Harbors Investment Corp. Now, lastly, let's get to a shift in policy from Governor Gavin Newsom here in California. And he's been a longtime proponent of shutting down the Diablo Canyon nuclear power plant, but he's now reversed course. And he's trying to go on a last-minute effort to extend the operation of the plant by a decade. And he cited unprecedented stress on the state's energy systems as a reason for keeping it open. In and of itself, it accounts for 9% of the state's electricity generation and 17% of its electricity from carbon-free sources. Now, tomorrow, California legislature will be voting on whether to extend the life of the plant. Now, proponents of extending the life of the plant argue that the steady power output is crucial to the state's reaching its goal of carbon-free electricity by 2045, and the fact that, hey, it's been operating incident-free since 1985. And it's especially true now that California is phasing out petrol-fueled cars and put more stress on the energy grid. And the heat wave means that there's lower water levels and less hydroelectric power coming from the dams. And this points to other states. New York State, for example, they shut down their power plants in 2020 and 2021, and all they did was turn on more natural gas plants. So it's actually reversed their climate objectives. And same thing's happening in Germany right now. They're actually turning to burning oil, burning coal, things that are completely against their climate objectives. And it's pretty clear that politicians, at least the relatively smarter ones, hard to say that about politicians, but relatively smarter ones are starting to catch on and seeing that nuclear is the path forward. So it's definitely a place that everybody needs to be paying attention to when it comes to your exposure to energy in your portfolio, the nuclear space. Now, I'm Justin Klein. This concludes another InvestTalk program. Steve Peasley and I thank you for listening. We encourage you to tell your friends and family about our free podcast downloads, which you can get anytime at iTunes, Spotify, Google Play, and be sure to rate and review on iTunes as well. Independent thinking, shared success. This is InvestTalk. Good night.
InvestTalk is a trademark of KPP Financial. Because of the nature of the interactive dialogue inherent in the format of this program, it's important for the listener to understand that not all comments made will apply to them. Specifically, nothing said shall be taken to be investment advice, or shall statements on this program be considered an offer to buy or sell security. Because such advice is rendered solely on an individual basis and at times will require that the investor review a prospectus before investing. InvestTalk is a copyrighted program of Klein, Pavlis, and Peasley Financial, a registered investment advisor firm which retains all rights.